Welcome. We're about to unlock one of the most powerful numbers in all of real estate investing. It's called the capitalization rate, but pretty much everyone just calls it the cap rate. Stick with me for just the next few minutes, and you'll know exactly what it is, how to use it, and most importantly, why it's so essential.
So let me ask you this. You've got two properties you're looking at. One's an apartment building down in Texas. The other is a little strip mall over in Florida. They're totally different types of buildings in completely different markets with wildly different price tags. So how in the world do you decide which one is the better investment? It feels like comparing apples to oranges, right? Well, that's the exact problem the cap rate was built to solve. Here's how we're going to break it down. We'll start with the what. Think of it as our investor's compass. Then we'll decode the formula. Don't worry, it's easy. After that, we get to the good stuff. Why this number actually matters. We'll bust a huge myth about it and cover what it doesn't tell you. We'll wrap it all up with a final key takeaway. Let's get into it.
Okay, first up, the investor's compass. Seriously, think of cap rate as your true north. It's the tool that keeps you pointed in the right direction when you're evaluating a property's potential. Now, if you look it up in a textbook, you're going to see this definition: the ratio of a property's net operating income, or NOI, to its market value. Yeah, I know, that sounds a little dry. Maybe your eyes are starting to glaze over, but hang with me for a second. Here's a much, much better way to think about it. The cap rate is the return, the annual yield you'd get if you bought the property with a suitcase full of cash. No loans, no mortgages, nothing. It strips all that away and tells you how well the property itself performs as a money-making machine. So how do we actually get this compass reading? Let's decode the formula. And I promise you do not need to be a math whiz for this. It's super straightforward. It's really just 4 simple steps. 1, you add up all the rent you'll collect for the entire year. 2, you subtract all the normal costs of running the place. What you're left with, step 3, is your net operating income, your NOI. And for the grand finale, step 4, you just divide that NOI by the property's price. That's it. Let's put some real numbers to that. Say you're looking at a duplex that costs $200,000. After you pay all the bills for the year, you're left with $14,400 in pure income. You just divide the income by the price, and you get a cap rate of 7.2%. Bam! Now you have a single, clean number to judge that property by. Okay, but that expenses part is absolutely crucial. So what counts? We're talking about the regular, ongoing stuff: property taxes, insurance, routine maintenance, management fees. What do you not include? Your mortgage payment. Remember, we're pretending it's an all-cash purchase. You also leave out major renovations or your personal income taxes. This is only about the day-to-day operation of the building. All right, so you've got the number. Now for the really important part. What do you actually do with it? Let's put this thing to work. Smart investors use it in 3 main ways. First, it's that awesome apples-to-apples comparison tool. Second, you can use it to analyze market trends. If the average cap rate in a city is going down, it tells you property values are going up. And third, it's a really quick, powerful way to get a gut check on a property's risk level. And that idea of risk, well, it leads us straight into the biggest trap for new investors. We've got to talk about the myth of the good cap rate and ask the million-dollar question. Is a higher number always better? I mean, it's the question on everyone's mind. You're looking at 2 deals. One has a 4% cap rate, the other is a whopping 10% cap rate. Your brain just screams, take the 10%, it's a no-brainer, right? Well, not so fast. The answer is no, not necessarily. You have to remember the golden rule of investing. Higher potential returns almost always come with higher risk. And sometimes a really high cap rate can be more of a warning sign than an opportunity. This shows that trade-off perfectly. That 4% cap rate, that might be for a brand new building in a top-tier prime location. It's safe, it's stable. That 8% or 10% cap rate, well, that could be an older building in a neighborhood that's a bit more uncertain. You're being offered that higher return as compensation for taking on a bigger gamble. Look, cap rate is a fantastic tool. It's an amazing compass. But a smart investor knows that even the best compass doesn't tell you everything. You have to know its limitations. It really has 3 major blind spots. First, like we said, it completely ignores your mortgage and financing. Second, it's just a snapshot in time. It's based on 1 year of performance and doesn't tell you what's coming next. And third, the old classic, garbage in, garbage out. The calculation is only as good as the numbers you start with. And that leads to a huge pro tip. You have to be a detective. Always, and I mean always, double-check the expense numbers a seller gives you.
It is so common for them to conveniently forget to include a few costs to make that cap rate look bigger and juicier than it really is. Trust, but verify. Okay, let's bring this all home. Time to zoom out and focus on the big picture, your final takeaway. This table really puts it all into perspective. You can see cap rate is unique. It measures the raw, unfiltered performance of the property itself. And yes, it ignores financing. Other key metrics like cash-on-cash return are all about your personal return based on your specific loan. They all have a job, but only cap rate's job is to tell you how good the property is at making money all on its own. So if you remember just one thing from all of this, let it be this. Cap rate is not the final answer, but it is always the essential first question. It's that quick back-of-the-napkin calculation that tells you if a property is even worth spending another minute looking at. And that's really the heart of it. It's so easy to get emotional, to fall in love with a property's cool kitchen or great location, but successful investing, the kind that builds wealth over time, is about being objective. It's about the numbers. And now you have one of the most powerful tools in the game to do just that.